in less than 3 minutes. Let's talk about some things that you probably didn't know about dividend stocks. A dividend stock is when the company pays out their earnings as cash payments to their shareholders. Usually, companies that are well established but not having a lot of growth will pay out higher dividends to their stockholders. You can also find companies that have been paying and increasing dividend payments for at least 25 straight years. They're also called dividend aristocrats. There are currently 65 dividend aristocrats in S&P 500. There are also an even more elite group of dividend stocks, and we call them the Dividend King. These companies have paid and increased dividends for at least 50 years in a row. You might know some of these companies like 3M, Coca-Cola, Lowe's, Target, and Johnson & Johnson. The formula for dividend yield is annual dividend per share divided by price per share. For example, if the stock's annual dividend rate is $2 and the previous close price for a stock is $50, then your annual dividend yield is 4%. Let me give you another example. Let's say you bought $10,000 worth of Walgreens Boots Alliance, ticker symbol WBA. The stock price is at $50 per share and Walgreens pays you $2 per share in annual cash dividends. This means you own 200 shares of Walgreens that pays you $400 in dividend every year. The dividend yield can change when the stock price changes. So the yield will rise when the stock price drops, and the yield will drop when the stock price rises. Most dividends are paid out 4 times a year or on a quarterly basis. However, some companies choose to pay dividends semi-annually or twice a year, annually, monthly, or sometimes they don't even have a set schedule whatsoever. Walgreens, for example, they pay their dividends to their shareholders on a quarterly basis in March, June, September, and December. Using my previous example, if you make $400 in dividend every year from Walgreens Boots Alliance, then you get paid $100 every quarter. There are 2 types of dividends. One is qualified dividend and the other one is ordinary dividend. Ordinary dividends are taxed the same as your federal income tax rate depending on your tax bracket. They're the portion of a company's earnings not reinvested in their business but paid directly to the investors. If you own stocks like real estate investment trusts or REITs, then you will always pay ordinary income tax for their dividend payments. Qualified dividends are taxed as capital gains tax, which are taxed at 20%, 15%, or 0%. You can check out the requirements for a dividend to be considered qualified on the IRS website. Well, you're going to have to find that out in the next video. So thanks for watching and check out these 2 3-minute videos as well as the new fire video coming out tomorrow, Sunday at 9 a.m. Have a good one.
Thanks for watching. Don't forget to hit the like button and subscribe for more fire videos.